It's 2024, and the chief inquiry on your mind could revolve around the impact of the current macroeconomic environment on your stocks or bond investments. As we know, inflation and potential interest rate reductions play a significant role in shaping the financial markets. Inflation tends to erode the purchasing power of money, affecting bonds negatively as they yield a fixed rate of return. Yet if the central bank decides to reduce interest rates, bond prices generally increase, making them a potential profitable investment. Meanwhile, stocks can be more resilient to inflationary pressures, potentially providing a hedge against those pressures. The best investment strategy will depend on your personal financial goals, risk tolerance, and investment time frame in relation to these economic factors. Stay tuned as we delve deeper into the complex interplay of inflation, interest rates, and your 2024 investment portfolio decisions. First up, let's delve deeper into the world of stocks and how the current macroeconomic data influences them. The performance of stocks is intertwined with the health of the economy. Factors such as GDP growth, inflation, employment rates, and consumer spending habits can have a significant impact on stock performance. As we know, strong economic growth often translates to robust corporate earnings, which in turn can push stock prices higher. Conversely, a slowing economy can hamper corporate profits, causing a decline in stock prices. Now, let's consider the potential for interest rate reduction. When interest rates fall, borrowing costs for companies decrease. This can lead to increased corporate spending and investment, which can boost earnings and ultimately stock prices. Additionally, lower interest rates can make stocks a more attractive investment compared to bonds or savings accounts. Therefore, the potential for interest rate reduction could be a catalyst for stock market growth. However, it's not all smooth sailing. A volatile market and fluctuating stock prices are part and parcel of investing in stocks. But as they say, no risk, no reward. Investing in stocks can be a roller coaster ride, but the potential for high returns often makes it a tantalizing option for savvy investors who understand the macroeconomic landscape. Now let's shift our focus to bonds. Considering the current macroeconomic data, it's evident that bonds could be significantly affected. Economic indicators such as inflation and unemployment rates can have a crucial impact on the bond market. In a scenario where GDP is growing steadily, inflation is under control, and unemployment rates are low, the resulting economic stability generally bodes well for bonds. Remember, the bond market is not immune to fluctuations. Now let's talk about interest rates. Given the potential for interest rate reduction in the foreseeable future, bonds could come into the limelight. When interest rates decrease, bond prices usually rise, and this could result in substantial profits for bond investors, but caution is key here. Lower interest rates mean bonds come with lower yields, which might not be attractive for potential investors. Bonds tend to be less volatile than stocks, making them a safer bet for the risk-averse among us. They can provide that crucial balance in your investment portfolio, a necessary counterweight to the more volatile elements. However, just like any investment, bonds come with their own set of risks. There's always the risk the issuer might default. So, while bonds might not promise high returns like stocks, they offer a different kind of allure, a more stable and predictable income stream, especially in a low interest rate environment. So, stocks or bonds, which should be your pick in 2024? Well, it's not a one-size-fits-all answer. Stocks offer potential high returns but come with volatility. Bonds are less risky, providing steady income but with lower returns. An alternative could be mutual funds, which balance risk and reward and offer diversification. Ultimately, your choice depends on your risk tolerance, investment goals, and time horizon. Remember, investing is not about chasing quick profits, but about growing your wealth steadily over time. Spend time and do the research. It seems highly likely that interest rates will be reduced in 2024, and this will impact investments. So choose wisely and invest smartly in 2024. If you found this video useful, please don't forget to like and subscribe to the channel.